Stock screeners are not really perfect as such, so they come with disadvantages I want to highlight in this video. So while stock screeners offer many advantages, they also have some disadvantages that investors should be aware of. So here are some key drawbacks of stock screeners. Number one is over reliance on quantitative data. Over reliance on quantitative data. So in this context, you have limited qualitative insights. Limited qualitative insight. So stock screeners primarily focus on quantitative data like financial ratios and technical indicators, which may overlook important qualitative factors such as management quality, competitive advantage, or industry trend. Discover that screeners don't really focus on the qualitative. They focus essentially on the quantitative. That's how they are designed to function. You only have ignoring context. Ignoring context. So screeners might miss the bigger picture, such as change in market conditions or broader economic factors that could impact a stock's performance. Screeners don't incorporate economic factors, and they may not even capture market trends or investor psychology or investor behavior. Kind of, they don't capture all because they're designed to capture mostly quantitative factors, factors you can measure in numbers. Number two is risk of narrowing focus too much. The risk of narrowing your focus too much. In this case, you have over filtering, setting too much filters or overly strict criteria can result in a very limited list of stocks, potentially excluding good investments opportunities that don't perfectly fit the chosen parameter. So you can miss out in very good investment because the screener could not really capture it. You have a missed opportunities. By focusing only on specific metrics, investors might miss out on stocks that are undervalued or have growth potentials but don't meet certain criteria. Some stocks have a tendency of growth, but because it is not captured in your criteria, you may end up missing out, investing in that particular security. Number three is data accuracy and timelines. Data accuracy and timelines. So you may have outdated information. So if the screener's data is not updated in real time, investors might make decisions based on outdated information, leading to poor investment choices. This is very serious. So the screener must be updated in real time, or else you may have results that are not relevant, that are kind of misleading. You have inaccuracies. Errors in data provided by the screener can lead to misleading results and wrong investment decisions. Number four is overconfidence and overtrading. Overconfidence and overtrading. So in this case, you have false security. Investors might become overconfident in their screening results, leading to excessive trading or reliance on the screener without conducting further research. It's a real disadvantage, actually. So increased cost. Frequent trading based on screener results can lead to higher transaction costs, which can erode investment returns over time. Number five is lack of personalization. Lack of personalization. So one size, a kind of one size fit all. Some screeners may not be flexible enough to fully align with an investor's unique strategy or preferences, limiting their usefulness. It can limit their usefulness because sometimes it will not really incorporate, an investor's unique strategy into its system. You have generic filters. Generic filters, many screeners offer only basic filters which may not cater to more sophisticated or specialized investment strategies. They sometimes look basic, and so you may not be able to cater for some level of specialized investing. Number 6 is um, complexity for beginners. Complexity for beginners. So it has a steep learning curve, kind of. So more for novice investors, stock screeners can be overwhelming and difficult to use effectively, especially if they are unfamiliar with financial metrics involved. If you don't know earning per share, you don't know revenue, you don't know, turnover, you know, what they call it, return on investment and other metrics. How will you be able to use the screener in the first instance? You must be familiar with these metrics before you can employ them in screening for stocks. So when it comes to beginner investors, it becomes a bit difficult. So misinterpretation. Beginners might misinterpret the results or rely too heavily on criteria on certain filters without fully understanding their implication. When it comes to screening stocks, you should be knowledgeable. That's the very first criteria before you now talk of screening for stocks. If you have no knowledge, then the entire exercise will yield, a poor result, an unreliable result, a result you cannot trade with. And please subscribe to this channel and like this video if you've not done that. And number 7 is potentials for overfitting. Potentials for overfitting. This has to do with backtesting risk. Backtesting risk. When using backtesting features, there's a risk of overfitting, that designing a strategy that performs well in historical data but fails in real-time market may not be applicable to what's obtainable in the future. And then equally have false confidence. So overfitted strategies might appear highly successful in the past, but may not be robust enough to handle future market conditions. There's one thing about investing, you make a decision based on past performance, but your results will then be obtained in the future. So how do you marry the two? That's the limitation involved even in research and backtesting. Number 8 is a limited by available data. Limited by available data. In this case, you have restricted indicators. The range of financial metrics and technical indicators offered by a screener may be limited, restricting the ability to conduct comprehensive analysis. In some cases, the screener may be limited one way or the other, so you will not be able to carry out comprehensive research on the stocks you actually want to invest in. So you have that you have that data gap. Some stock screeners may not include all available stocks, particularly smaller international stocks, limiting the pool of potential investment. They may exclude some smaller companies from emerging markets, as the case may be. So you may end up not benefiting from those stocks, even if when they end up doing very well. Number 9 is may encourage short-term focus. It may encourage short-term focus. In other words, it incorporates focus on immediate metrics. Screeners often emphasize current financial metrics or recent price movement, which might encourage a short-term focus rather than a long-term investment perspective. It encourages short-termism kind of in the markets. And then you have volatility risk. The investors might be tempted to trade based on short-term fluctuation rather than on holding for the long run, rather than buying, incorporating a buy and hold strategy. Number 10 is dependence on technology. Dependence on technology. So you have technical issues. Screeners are reliant on technology, meaning they are susceptible to glitches, to server downtime, or other technological or technical issues that could disrupt, their availability as well as some functionality. And you have a learning curve for advanced tools. When it comes to advanced tools, it might be difficult to actually comprehend. So more advanced screeners may have a steep learning curve, requiring significant time and effort to be able to master how to use them.